Hello and welcome to today's webinar with the Biotech Growth Trust, ticker BIOG. Today we're joined by Geoff Hsu, General Partner at OrbiMed and Portfolio Manager of the Biotech Growth Trust, a role he has held since 2005. The webinar today aims to provide an overview of the brightening prospects for biotech, given that the sector has faced an extended period of turbulence but is now seeing some improvements. Following Geoff's presentation, there will be an opportunity for Q&A at the end, so please feel free to send in your questions via the Q&A function on the webinar platform at the bottom. For those who don't know me, my name is Arron Aatkar, a healthcare and investment trust analyst here at Edison. Geoff, going to hand over to you now for the presentation.
Thank you so much, Aaron, and thank you everyone for joining this webinar today. I'm happy to give you guys an update on the Biotech Growth Trust. First off, for those of you who are unfamiliar with the trust, my name is Geoff Hsu. I'm a general partner at OrbiMed. I've been at OrbiMed since 2002, and I've been a portfolio manager of this particular trust since 2005. This particular trust is managed as well by my colleague, Josh Gollum, who's also a partner at OrbiMed, and each of us have over 20 years of experience investing in the biotech sector. So just a little bit about the organization that I work for, OrbiMed. We are a global healthcare dedicated investment firm with over 25 years of experience investing solely in the healthcare sector. We manage about $19 billion in assets currently, as shown on the pie chart on the left, and you can see that that $19 billion is distributed across a number of different business lines. So we have a venture capital business, we have a royalty and structured debt business, but you can see that the Biotech Growth Trust, as well as its sister trust, the Worldwide Healthcare Trust, make up a majority of our public equity business. We have 148 employees globally. We do have a true global footprint with offices worldwide: Shanghai, Hong Kong, Mumbai, London, San Francisco. And collectively, this group of professionals brings over 300 years of experience, investment experience, to the organization. We are continuing to expand as a firm, and 34 of my colleagues have either an MD or PhD degree, so there's a lot of technical expertise in-house. Turning now to performance, here's a graph showing the NAV performance of the Biotech Growth Trust since our inception as managers in May of 2005. The NAV is shown here in blue. The performance of our benchmark index, the NASDAQ Biotech Index, is shown here in gray. And you can see that up until early 2021, we had accumulated quite a bit of excess performance versus our benchmark index. But then in the latter half of 2021 suffered a significant performance drawdown that we think was completely disconnected from industry fundamentals, unprecedented in its severity and its duration. And we're in the midst of now recovering from that extended drawdown. And you can see over the last 6 months, that recovery we think has begun, and we think it's going to be a sustained recovery, and hopefully we can recapture the performance highs we had back in early 2021. So just zooming in on recent performance here is the performance of the Biotech Growth Trust for the current fiscal year. We do have a March 31st fiscal year end. So this is the 6-month period from March 31st, 2025 through September 30th, 2025. You can see that the NAV during this period is up 37%, well exceeding the performance of the benchmark index, the NASDAQ Biotech Index, which was up 10.6% over this period. In October this month, we're actually having a very strong month as well. So both in absolute and relative terms, we're up about another 15% so far this month. So that rally and that performance is continuing. And just to explain exactly what's going on here, a lot of that performance is driven by the fact that we structurally are overweight small and mid-cap biotech companies in particular versus our benchmark index. So if you look at the table here on the lower left-hand corner, at the market cap breakdown of the portfolio constituents of the Biotech Growth Trust as of March 31st, 2025, we've categorized the portfolio constituents into 3 major market cap categories: large cap stocks in excess of $10 billion in market cap, mid-cap stocks between $2 and $10 billion in market cap, and small cap stocks less than $2 billion in market cap. And if you juxtapose that portfolio construction versus the NASDAQ Biotech Index, you can see that we began this period significantly overweight small caps and mid caps and significantly underweight large caps versus the index. If one then tracks the average stock price performance of the index constituents in each of those market cap categories, you can see that over the past 6 months, small caps in gray have significantly outperformed large caps in blue and mid caps in green. So that of course, given our positioning, led to some great excess performance versus the benchmark over this period. Now, we did end the period with similar strategy and structurally overweight against small caps and mid caps. You can see actually our small cap overweight increased over the 6 months because we do think small caps in particular have the most upside from this point forward, and we're still significantly underweight large caps. So, the reason why we are structurally overweight small caps to such a great extent is really illustrated by this slide here. So this is a slide showing the performance of 4 indexes since March 31st, 2021. So basically over the past 4.5 years. You can see the S&P 500 in gray at the very top, up 84.5% in pound sterling terms over this time period. Below that in dark navy, you see the S&P 500 Healthcare Index. This is an index that just captures the healthcare constituents of the S&P 500. And you can see that actually healthcare as a sector has underperformed the broader S&P 500 for about the past 2 years. Below that in light blue, the Russell 2000 index. This is a broad-based market-wide small cap index. And I would say that small caps, as you can see on this slide, have also underperformed large caps for the past 4.5 years. But the one index I'd really like to highlight is the one at the very bottom in green, and that is the Russell 2000 Biotech Index. This is an index that captures performance of small cap biotech in particular, and you can see that it has underperformed the S&P 500 by an astounding 116 percentage points. We don't think that underperformance is merited or justified based upon the fundamentals of the industry, and we do think there's going to be a tremendous performance reversion in that particular segment of biotech over the coming months. And one of the reasons why we believe that performance reversion is going to take place is because this drawdown that began in 2021 really drove biotech valuations to record lows, unprecedented lows, and that's illustrated by this slide here. So one objective way to just look at biotech valuations is simply to take the ratio of the market caps of these companies and compare that to the net cash that these companies have on their balance sheets. If one plots the median ratio of market cap to net cash on balance sheet for the industry since 2001, you can see that this latest protracted drawdown has really driven absolute valuations to record lows. We're trading at levels below the dot-com bust, below the great financial crisis, below Hillary Clinton's election campaign in 2016 when she talked about drug price reform. So really, really unprecedented lows that we've never seen before. There was an attempted rally in the sector in late 2023 going into 2024, but you can see that that rally was cut short prematurely after Trump's election because of delays in expected Fed interest rate cuts, because of the appointment of Robert F. Kennedy, a noted vaccine skeptic, to head up the Department of Health and Human Services, and because of Trump's budget cuts across the government. People were concerned that FDA budget cuts might impact the drug approval pace. And so those political uncertainties that emerged post-Trump's election really drove valuations all the way back down again to record lows. What we've seen in the last 6 months, though, is a nice recovery. And we do think this recovery is going to be more sustained. And the recovery is based upon a lot of those political uncertainties abating. We're seeing increased M&A activity in the sector. We had 2 very significant M&A transactions that were just announced this month. And importantly, the Fed has started to cut rates. So last month, the Fed instituted a rate cut. This week, they instituted another rate cut. As we get into a rate cutting cycle, that should be a nice tailwind for biotech performance. So another way to look at sort of where absolute valuations have been in biotech is to simply plot the percent of biotech companies trading at market caps below the net cash on their balance sheet. That's exactly what we've done on the left-hand graph on this slide. And you can see just how anomalous and unusual this drawdown has really been. So at the lows, over 25% of the entire biotech industry was trading at market caps below the net cash on the balance sheet. We've never seen anything like that before. That translates on the right in terms of number of biotech companies. Again, at the lows, over 150 companies were trading at market caps below the net cash on their balance sheet. So really unprecedented, anomalous valuations. And fortunately, as you can see by the red circles here, that is beginning to correct, but we are still very far away from the historical average. So we think there's quite a bit more to go in terms of a valuation recovery for the sector. And one of the catalysts for that recovery is what's going on with interest rates. So biotech companies generally don't have a lot of debt, at least the earlier stage ones. But the reason why interest rates are relevant is because when one is constructing a discounted cash flow valuation for a company, obviously the risk-free rate, in this case the 10-year US government yield, is an important component of the discount rate that one is going to use to discount back those future cash flows. If that risk-free rate is higher, obviously the discount rate is higher, and that's going to affect present valuations. So here is a graph showing 10-year US government yields in black since 2005. We've overlaid on top of that year-over-year inflation in the United States in light green as captured by the US CPI, Consumer Price Index. And you can see that starting in 2021, the 10-year interest rate did start going up quite dramatically, and that was due to expectations that the Fed would need to raise rates in order to combat inflation in the United States. So that policy was successful. The Fed did indeed raise rates pretty consistently throughout 2022 and into 2023. But inflation, as you can see, peaked in the middle of 2022 and has been in decline ever since. So we do believe that the rate increases have stopped at this point. And fortunately, we believe we're actually now in a rate cutting cycle. Again, last month, the Fed cut rates. They cut rates again this week. And we do expect future rate cuts going into 2026 that should hopefully start sending the 10-year rate down. And that should act as a nice tailwind to biotech performance. So moving on to investment themes, and I just really want to reiterate the main message of this presentation, which is the unprecedented severe drawdown that we saw in biotech valuations starting in 2021, in our view, is really unjustified based upon the industry's fundamentals, which are very, very strong right now. And to illustrate that, here's a slide showing key breakthroughs in biotech just this year in 2025. Highlight a couple of these. Unicure, for example, in the middle of the page, just recently announced very positive data for their gene therapy. This is a completely novel mechanism of action for a rare genetic disease called Huntington's disease. And this particular gene therapy showed it could slow disease progression for this incurable disease by about 75% over a 3-year span. So unprecedented clinical benefit with a very novel mechanism of action using gene therapy. Very, very significant in our view. Market potential for this drug. We think this could be a multi-billion-dollar therapy ultimately. Another one I'd like to highlight, the third one from the bottom, another company called Abivax. Again, they have a drug with a completely novel mechanism of action called an MIR-124 enhancer, and they also recently showed very positive data in a condition called ulcerative colitis. Again, we think that unlocks a multi-billion-dollar opportunity for this particular company. And in fact, we think this company could be a nice M&A takeout candidate by a large pharma player. And those great scientific breakthroughs are translating into actual drug approvals. So here is a slide showing significant FDA biotech approvals in 2025. Some of them are for rare diseases like acromegaly. Others are for more common diseases like moderate to severe acute pain. But if you look at the right-hand column of this slide, every single entry on this slide has the word first in bold. And that is because every single drug on this slide is groundbreaking in some way, either because it's the first drug approved with a novel mechanism of action or the first drug approved for a particular disease or patient population. So a lot of groundbreaking science taking place, leading to important, significant drug approvals in biotech. So just to highlight a couple of areas where a lot of innovation is taking place. One area is oncology. Cancer remains the #1 therapeutic area for biotech drug development, given the significant unmet medical need in cancer. And we've just displayed on this slide 6 different approaches that are being applied to develop cancer therapeutics. We have cellular therapies, we have antibody-drug conjugates, we have bispecific antibodies. These are antibodies that can bind to 2 different targets simultaneously. We have targeted therapies that target specific genetic mutations. We have radiopharmaceuticals. This is where you actually take a radioisotope and bind it to an antibody. And when you inject it into the patient, the antibody hones in on the particular cancer and delivers that radiation specifically to those cancer cells to kill them. And then we have cancer vaccines, which encompass a number of approaches to stimulate the immune system to attack cancer on its own. So multiple innovative approaches being used to treat cancer, and importantly, every single one of the technologies being applied here have already shown positive proof of concept in human clinical trials. So these are not theoretical approaches. These are actually approaches that have been validated and shown to work in human clinical trials. So this is generating tremendous clinical benefit across a number of tumor types and really gives physicians more treatment options to extend the lives of cancer patients. Another area that I'd like to highlight is the area of central nervous system diseases. So these encompass a broad range of diseases in both neurology and psychiatry that really offer large chronic market opportunities. So this would include antipsychotic therapies, therapies for depression, therapies for epilepsy, pain, neurocognitive disorders like Parkinson's or Alzheimer's. That's a significant unmet medical need. We have therapies in development for neuromuscular disorders as well as movement disorders. And the great thing about a lot of these categories, as I mentioned, is that they really can unlock multi-billion-dollar revenue potential for therapeutics in these very large markets. So large pharma companies in particular have shown a lot of interest in the CNS space with recent multi-billion-dollar acquisitions of some biotech players, including Intracellular Therapies, Karuna, Cerevel, Longboard. The names that have an asterisk next to them on this slide are names that we actually held in the portfolio as of September 30th. And recently, actually, Avidity in the neuromuscular disorder box was recently acquired by Novartis. So we do expect, hopefully, more M&A activity to occur in this space in the coming months. And so as a shareholder of the Biotech Growth Trust, you will get exposure to a nice cross-section of the latest and greatest innovative technologies in biotech. So here are a number of those technologies, as well as the percent NAV exposure to each of those technologies in the portfolio as of September 30th. And we've also listed down below some examples of portfolio positions that are utilizing that particular technology. Now, our exposure to each of these technologies will change dynamically based upon where we believe the best investment opportunities lie at any given time. So you will see the exposure shift between one technology and the other. But overall, again, you'll get a nice exposure to a nice cross-section of all the different technologies that are being applied in biotech. Next, turning to the regulatory environment, we have had a very positive, constructive regulatory environment at the FDA really for the past 8 or 9 years. Here is a graph showing the number of new drug approvals at the FDA each year since 2016. You can see that starting in 2017, which was the first year of Trump's first administration, we did see an elevated number of drug approvals. Trump really was very enthusiastic and really wanted to get drugs approved and onto the market as quickly as possible. And that elevated rate of drug approvals was really sustained throughout Trump's first administration into Biden's presidency, his 4 years. And it seems like in 2025, if one annualizes the number of drug approvals for the first 3 quarters of the year, you can see in the dotted box there, the annualized number in terms of drug approval pace for 2025 seems on par with the elevated rate we've seen over the past 8 years. So everything is very consistent in terms of drug approvals. And I think certainly the mentality of the current FDA, based upon their public statements, is to continue to have a very flexible stance with regards to approval requirements and really try to get these drugs on the market as quickly as possible. Next, let's talk about M&A. This has been a historical driver of returns for the biotech sector. Here is a graph at the top showing announced public biotech M&A transactions since the beginning of 2018. You can see that there was quite a bit of activity in 2023, a little bit of a lull in the second half of 2024 as a lot of those large pharma companies digested those acquisitions. And really, I think some of them also had a wait-and-see approach in terms of waiting for what Trump was going to do with regards to healthcare after his election. But you can see, fortunately, so far in 2025, the M&A activity has really picked up. And we do expect continued strong M&A activity in the months ahead. If you look at the lower left-hand corner, we have just a number of quotes from big pharma companies, CEOs, from their earnings calls talking about the importance of M&A to their business strategy. And in the lower right-hand corner, we see some M&A transactions where the Biotech Growth Trust actually owned the target company at the time of acquisition announcement. So shareholders benefited directly from that M&A activity. And in fact, 2 of the largest ones, Akuro and Avidity in the lower right-hand corner, were just announced this month. Both of them were portfolio positions in the trust. So one of the reasons why we are expecting M&A activity to accelerate is because Big Pharma does have an urgent need to acquire new products. And that's because a lot of their blockbuster drugs right now are due to face a patent cliff in the coming years before 2030. So on the left, we have plotted out the branded sales at risk for Big Pharma due to an upcoming loss of exclusivity on their drug, where the drug is actually expected to face either generic or biosimilar competition. And on the right, you see a list of a number of examples of those blockbuster drugs that are due to lose patent protection. So clearly, these big pharma companies have a revenue shortfall that they're going to need to remedy, and they're going to do it by aggressively acquiring biotech companies that will be able to deliver revenue in the future and offset that patent cliff. Next, the next theme I'd like to highlight is actually the rise of innovation in China. So China basically in 2015 announced as part of their 10-year Made in China 2025 plan that they wanted to make developing a domestic biotech industry a priority for the government. And so we had explicit government support for growing a biotech industry in China. And indeed, biotech as an industry has blossomed quite a bit over the past 10 years, to the point where we believe Chinese companies' R&D capabilities are now on par and in some cases better than their US peers. These companies can really conduct clinical trials faster and cheaper than their Western counterparts, and that really shortens the drug development timelines in biotech. One interesting statistic, if you look at the top of this page, is if you just plot the market share of clinical trial activity for the worldwide biopharmaceutical industry, you can see here on the right that China in light green now accounts for 30% of clinical trial starts worldwide in biotech. And that already exceeds the 21% share of Europe and is rapidly approaching the 35% share in the United States. So if you think about it, how profound that is, China now accounts for roughly a third of clinical trial activity in the biopharmaceutical industry worldwide. Now, many big pharma companies have obviously noticed this, and in fact, over the past couple of years, they have been aggressively in-licensing promising innovative assets from Chinese biotech for development in the US and Europe. And the business model is gradually shifting such that big pharma companies are saying, well, if we can conduct phase 1, phase 2 trials, earlier stage trials, faster and cheaper than in the United States, why don't we do that in China, get proof of concept, in-license the compound then for rights in the US and Europe, and then conduct the large, pivotal, registrational phase 3 trials that you need to conduct to get approval in the US and Europe. So we've seen a number of very interesting business development deals over the past year, and that has driven a lot of Chinese biotech performance year to date. Now, interestingly, we do, I think this is a differentiating aspect of our particular platform versus others in this space. We do actually have a local analyst team of 3 individuals based out of our Shanghai and Hong Kong offices who are sourcing those Chinese investments. And Chinese biotech in general and those investments have done very well so far this year in 2025. So just looking at Chinese healthcare broadly, this is a plot actually of the Hang Seng Healthcare Index. This is an index that consists of Chinese healthcare companies that trade on the Hong Kong Stock Exchange. Now you note that since June of 2021, this index actually fell quite a bit, unfortunately, in tandem with the drawdown in U.S. biotech, but for very very different reasons. So the fall off here was really due to COVID restrictions, due to a slow Chinese economy, and so forth. But fortunately, you can see year to date, we have seen a nice recovery in Chinese healthcare, including biotech, and that's really been driven by the innovation we're seeing in Chinese biotech and business development deals being signed with U.S. big pharma players. We are still 44% below the highs of 2021, so we do think there's still quite a bit more to go in terms of recovery in Chinese biotech in particular. Turning now to political uncertainties, I mentioned that earlier, but we think a lot of the political overhangs that really cut short the first attempted rally in 2024 after Trump's election, those overhangs are really lifting. And we think overall, actually, the Trump administration is very positive for the biotech sector. So first off, on the positive end of things, in terms of innovation, Trump's administration is generally pro-innovation. That's consistent with his broader domestic pro-business agenda. He believes in reduced regulation. So the FDA has publicly stated that they actually want to reduce regulatory hurdles to drug approvals and really speed up the drug development process. And I would say that the biotech industry does enjoy broad bipartisan political support. So recently a Senate report actually recommended further government support of biotech as a strategically important industry for the United States. And then down below, we've listed a number of the uncertainties that really made biotech sector, that really weighed on biotech sector performance earlier on in 2025. So the first one, of course, is the appointment of Robert F. Kennedy as head of the Department of Health and Human Services. Again, investors feared that having a noted vaccine skeptic as head of the HHS would somehow stymie drug approvals, make the FDA less science-based. That has not happened for the drug sector. I think vaccine development, admittedly, is is going to be more difficult and trickier from here on out. But again, the FDA commissioner, Marty Makary, seems very reasonable and science-based. The budget cuts that Trump has instituted across the government, including at the FDA, has apparently had no negative impact on the rate of drug approvals. So we haven't noticed any apparent slowdown in drug approvals. And in fact, Makary again says he wants to approve more drugs more quickly. So that sort of investor concern is also abating. Drug price reform, I mentioned, one thing that Trump has introduced by executive order is this concept of a most favored nation policy for pricing of drugs in the United States. So he's very, very upset that Europeans pay less for drugs than consumers in the United States. He does want to equalize pricing across continents. And this is an executive order that actually he proposed during his first administration and really didn't go anywhere. We think for an MFN policy to really have teeth and be enforceable, it would really have to be passed via legislation in Congress. We think that's very unlikely to pass Congress. But interestingly, Pfizer recently announced a deal with the Trump administration where they said they would be willing to offer so-called most favored nation pricing for their drugs for the Medicaid program. This is the government-sponsored healthcare insurance program for the poor in the United States. And that kind of gave Trump a headline win. So he's able to say to the electorate, I'm doing something about drug pricing. Pfizer also announced that they would be offering a number of drugs directly to consumers via a website called Trump RX at a deeply discounted price. And so Pfizer really promoted this deal with Trump. Trump got a nice headline win, but importantly, the financial impact of this deal actually is very minimal for Pfizer. So it's actually going to have very little impact on the earnings profile of Pfizer going forward. And this deal really set a template deal for other big pharma companies to sign similar deals. And in fact, AstraZeneca just a few weeks later did sign a very similar deal with the Trump administration. So we do expect a parade of large pharma companies to sign similar deals with Trump. That's going to allow Trump to say to the electorate again that, I'm doing something about lowering drug prices, and hopefully this issue will gradually fade from the headlines. And then lastly, with regards to pharmaceutical tariffs, he did threaten at some point to institute significant tariffs on pharmaceuticals. I would just note that cost of goods sold for drugs is actually very, very small. Biotech companies in early stage development have time to change their commercial manufacturing plans to make sure they're sourced out of the United States. And importantly, the Trump administration did sign a deal recently that caps pharma tariffs at 15%, which I think is very, very manageable. So I think the tariff risk has also abated quite a bit. So overall, again, we think the Trump administration is net positive for biotech. And as those political uncertainties fade away, we think that's going to lead to further recovery and appreciation in biotech share prices. So just to sum up, what's our strategy and outlook? Our strategy in the fund is really to continue to emphasize emerging biotech over large cap biotech to fully capture the sector rebound that we're experiencing right now. We're going to capitalize on compelling investment opportunities in companies that need to finance at low share prices. We'll maintain an appropriate level of China exposure as opportunities arise. And gearing level, you should expect to generally stay between 5 and 10%. The unprecedented low valuations in emerging biotech does suggest significant upside from current levels. We've had a record performance drawdown of small and mid-cap biotech in particular versus the S&P 500. That's really been the longest and most severe we've ever seen. percent of biotech companies with market caps below the net cash on their balance sheets is well above historical norms, and we do think continued Fed interest rate cuts should be a nice catalyst that will help the sector recover. The valuation contraction that we've seen since 2021, we think is really disconnected from the fundamental innovation taking place in the sector, which remains very robust. We do expect M&A activity to accelerate given the lower valuations of biotech targets and the urgent need for new products by big pharma. And then, as I mentioned, we do think the Trump administration is ultimately supportive of the biotech industry, and those political overhangs will continue to lift. So overall, we do think this is a very opportune time, an excellent time, to invest in biotech innovation at unprecedented low valuations. So with that, I'm happy to move forward with questions. Aaron?
Fantastic. Thank you very much for the interesting presentation and nice overview of why sentiment should be improving in biotech, particularly like the emphasis on the firsts and recent breakthroughs and FDA approvals. As a reminder to our audience, if you'd like to ask a question, you can do so by clicking the Q&A feature in the platform at the bottom corner of your screen and type in a question there. While we wait for some of those to come through, I wonder if I can kick things off, Geoff. Saw earlier today sort of the obesity scene heating up a little bit between Novo, Pfizer, almost fighting for Metsera. It's keen to hear your thoughts in general about the excitement around the obesity market, and then maybe touch upon how the Biotech Growth Trust is positioned to capture that.
Sure. So as you know, we have two dominant leaders in the obesity space that have really achieved record revenues from their products, and that is Eli Lilly and Novo Nordisk. I would say that Eli Lilly, in addition to their GLP-1 agonists, which are selling very, very well, they also have a strong pipeline of next-generation obesity treatments to really guard the value of this franchise. Novo, unfortunately, doesn't have as much of a robust pipeline, so you can see that the share price there has been under quite a bit of pressure. I think there are selective opportunities to invest in obesity in the biotech space, but we have to be cognizant that Lilly and Novo are way ahead from a timeline perspective. So for something to come into the market now, it really has to be significantly better in our view than those incumbents. We have had selectively some investments in the obesity space. We have an investment, for example, in a company called Therapeutics that has an oral GLP-1 that we think might be interesting. But I think we have to be very, very careful to make sure that whatever biotech company is arriving now and developing a product now, that product actually is superior in some way to what's on the market today.
Sure. That makes a lot of sense. Thanks very much. Can see we've got some questions come through now. So Geoff, I'll hand that back over to you to panel those.
Sure. So we have one question about, shouldn't your overall benchmark really be the Russell 2000 biotech? Wondering how you've done since inception versus this index. So I think structurally speaking, yes, we are overweight small and mid caps, but we do still have some large cap exposure in the portfolio. I would say that in down markets, as you might expect, large cap biotech tends to perform better. They're lower beta stocks. They go down less than small and mid cap biotech. And I think some of the challenging performance we faced over the past 4.5 years is because we have had this overweight positioning in small cap biotech, which was the part of the universe that really was really hurt the most with this unprecedented drawdown. So given that we still have some large cap exposure, I don't think having the Russell 2000 biotech index, which is purely a small cap index, is necessarily appropriate. But I will say that structurally, we're not expecting to change sort of our small and mid cap focus. When we look at where we think we can deliver the most added value, it's actually in the small cap and mid cap space. That's where we think we can generate the most alpha. And unfortunately, it's just been that the small cap end of the universe has been the part of the universe that's had the most negative sentiment over the past 4.5 years, and that's what's been challenging. I think in this recovery coming up, we hope to generate a lot of excess performance versus the NASDAQ Biotech Index, where a lot of the our added value and our strengths will really be manifest in the share price. Another question here. I think that M&A is an important theme. Was it a particular deal that sparked the move off the bottom for biotech stocks? I note that BioG had 4% invested in Avidity. That's correct. That received a 46% bid premium this week. If it was not a deal announcement, was there another catalyst to get the sector moving after such a brutal and protracted drawdown? So I think, as I noted in the presentation, it's really been a number of factors that have led to recovery. M&A is certainly part of that, but as I mentioned, I think interest rate cutting cycle is another component of that. Frankly, just positive clinical data. We've had a lot of positive clinical data from a lot of these companies. So again, I think ultimately innovation and are these companies producing good drugs, I think ultimately is what you should be looking at in terms of value creation here. And then again, I think the political overhangs have abated. So I think it's not just M&A that's led to recovery here, but it's really a constellation of other factors as well. One of the greatest challenges about investing in China is competition making some deals uneconomic. So obviously with China, we have some exposure here. And we're going to dial up and down the exposure based upon where we see the current opportunities. I will have to say that since quarter end, since September 30th, we actually took profits in a lot of our Chinese biotech names. And one aspect, obviously, that we have to be very cognizant of is the geopolitical climate, the relationship broadly between the U.S. and China. Now we're, I guess, optimistic that unlike a lot of other sectors like semiconductors, things that are very relevant to national security, where Trump obviously is very concerned that U.S. technology, U.S. sensitive technology is being acquired by China, this is actually a case where great Chinese technology is being acquired by U.S. companies to deliver clinical benefit for U.S. patients. So in this instance, like technology is actually going the other way, other direction, and so we're hopeful that Trump is not going to in any way kind of stop that flow of technology and know-how, and we just have to make sure that we pick the right companies with the right technologies going forward. There is a lot of competition in the space generally. I do think that our on the ground presence in China gives us a better insight into potential competitors actually to U.S. biotech, and really gives us a nice a view of the landscape and the entire field of drug development. So I think that's going to help actually our U.S. investing as well. Can we hear your thoughts on the role of artificial intelligence in drug development and how you think about sifting those using it most effectively from the noise? So I would say that broadly speaking, every single company in both biotech and pharma is utilizing artificial intelligence in their drug development process. I think it's very, very difficult to ascertain exactly which companies are doing it most effectively. I would also just note that given the fairly long drug development timelines, even if one, for example, decides to develop a certain drug based upon artificial intelligence, it's going to take a while for you to know whether that bet was successful, right? You need to test it in human clinical trials. That takes a long time. So I think we're very, very early in realizing the actual potential of artificial intelligence, but certainly it is something that every single company is employing in their process right now. Can you elaborate on how you see the growing pace of innovation in China evolving in coming periods? In other words, do you see the pace continuing to grow or leveling off? And how is this considered when managing your portfolio? So I don't see any abatement in the pace of Chinese innovation in biotech. This is something we have to be very cognizant of course. And I would just, as an example, just mention other industries where the Chinese government has explicitly made it a priority to prioritize that industry. So if you look at solar panels, if you look at electric vehicles, rare earths, when the Chinese government sets their sight on a particular industry and gives it explicit government support, they have a pretty good track record of becoming the leader in that industry. And so we do think the center of gravity for innovation in biotech worldwide is gradually shifting eastward towards China. Let's see. You anticipated an uptick in M&A, and there has recently been a series of acquisition announcements. In which therapeutic areas are these bids occurring, and what levels of premiums and how do these compare with history? So I think M&A is occurring, frankly, across all therapeutic areas. I would say a lot of the M&A is occurring in de-risked assets where particular drugs have already shown very convincing data in phase 2 or phase 3 clinical trials. Those later stage assets obviously are going to be able to deliver revenue for the acquirer sooner than an early stage asset. But I would say that there's a difference in sort of what these acquirers need. Some acquirers, big pharma companies, need large revenue opportunities sooner, maybe to offset a patent cliff. Other companies like Eli Lilly, who are very well positioned and don't have the same patent cliff urgency, they may want to be actually acquiring companies that are earlier stage, because they already have a robust obesity franchise for the next several years, and they're looking for something earlier stage that's going to be kind of the delivering revenue for the next phase of their growth. So it does vary in terms of what people are looking for by sort of the particular needs of each big pharma company. And I would say that ultimately, though, I think companies are generally looking for products that have multi-billion-dollar revenue potential. I would say at least $2 billion of revenue potential. So smaller companies with maybe $500 million of revenue potential, that's probably going to be an opportunity that's less likely to be acquired by a big pharma company. You really need those large multi-billion-dollar assets to really move the needle for big pharma. And so what does that mean? That means that the therapeutic areas that they're going to go after are large markets, cardiovascular, central nervous system diseases, something like Alzheimer's or something like that. So those are the therapeutic areas where we think there's going to be a lot of activity. And then with regards to the premiums, I think the premiums have been fairly healthy in our view. We do, as part of our normal valuation process, look at each of the biotech companies and try to come up with an estimated takeout value. What would this company be worth if it was taken out by a larger player? And in general, the actual announced transactions have been very consistent with actually the valuations we've calculated for those particular assets. How might you compare and contrast your strategy versus the other biotech investment trusts in the UK market? So look, I think, versus some of the other investment trusts in the market, I think there's some trusts where I believe the strategy is, frankly, to just pick names that are going to be acquired in M&A, and that's certainly a part of our strategy. I would actually say that about 80% of the NAV of the fund is in companies that we think could be interesting M&A targets for a larger player. But there are certain other trusts out there that we know of that, where that's really a core part of the way they invest, and maybe they are less willing to take binary into clinical events. I think we're a little bit more willing to take clinical event risk, if you will, taking holding companies, for example, into phase 3 clinical trial results and so forth, where we feel like we do have a differentiated view. And I think we do also have preferential, I would say, deal flow in terms of what we call wall-cross transactions, where there's a small company, they need to finance, a bank will reach out to a select number of healthcare investors and say, this company needs a financing, can you take a look? And we are restricted in that stock during that financing evaluation phase. But in a lot of those financings, especially at the small end of the spectrum, you can get some nice bells and whistles and a great valuation. So we've done a number of transactions recently where we got what's called warrant coverage. So in addition to investing in the stock at a discount, we might get 100% warrant coverage, 200% warrant coverage, and that really does can make a tremendous difference in the return profile of those investments. And I think not all of the other investment managers in the UK market have access to that deal flow. Given our stature in this industry, OrbiMed's a well-known name in healthcare investing, we do get preferential access to that deal flow. And that's also true, frankly, for our Chinese IPO investments. If we want to get a good allocation to a hot IPO in China, given our longstanding on-the-ground presence there, I think we have a much higher probability than many other managers in getting allocation in those IPOs. So I think those are some of the differentiating characteristics of us versus some of the other players in the market. Let me see, anything else here?
think that might be the last one. So yeah, look, that concludes our Q&A session today. Geoff, thank you very much for taking the time and for the highly insightful presentation. Thank you also for our audience for dialing in, for asking your questions. If you'd like to learn more about the Trust, please feel free to refer to Edison's website, where we have our research and content on the Biotech Growth Trust, open access and freely accessible. A recording of this webinar will be made available in the coming days too, so please keep an eye out for that. Thanks again, everyone, and have a good day.
Thank you, Aaron. Thank you, everyone.